Hello, I'm Brian Lucareli, Director of our Private Client Services Group and co-chair of our Family Offices team at Foley & Lardner. And today I'm here with Michael Calabrese of Counsel and member of our fund formation and investment management practice. Michael, welcome and thank you for joining us.
Thanks for having me, Brian.
And today Michael's going to discuss private market investments. But Michael, before we get started, I think it might be helpful for our audience if you could share a little bit of your professional background with our audience.
Yeah, sure. I got into this field actually coming out of my time in public service back in 2009 in particular. I was the general counsel to a county pension fund up in the Central Valley of California. And that was a small fund, about $500 million at the time, but big enough to be making some forays into private markets. And that grew to being the general counsel of a much larger pension fund. So we were a lot more active in that space down in San Bernardino County. And from there, about 5 years ago, moved over to Foley to start serving, lots of different pension funds and lots of other different institutional investor clients doing the same kind of work. So it goes back about 13 years all told.
Good, and clearly a national practice for you, right?
Absolutely. Yeah, we serve clients literally from coast to coast.
Good. Well, thank you for the background, and I think that's helpful. So with your assistance, I've got a couple of questions today that I want to pose and tap into your insights on. So kind of question number one, what are the trends that you are seeing that are most important to institutional investors in negotiating and managing private market investments in today's environment?
Yeah, one of the sort of bigger picture trends kind of spreads across that whole 13 years I was talking about a moment ago, which is back then when we were starting to dip our toes into the space at the smaller fund. That was right on the heels of the great financial crisis, and sponsors at that time really needed capital, and we found at that time that we could talk about terms, and even as a small investor, which we were, largely asked for terms and get accommodated because there was just a need for our capital at that time. That pendulum has really swung pretty much in the same direction the entirety of that 13 years to where we sit now. Even the larger investors have a lot of trouble dictating their terms, even on some really important things, a couple of which I'll go into in a moment. One of the things that I have found is that it can be really advantageous for investors to have policies on certain highlight terms where they write down what they need and what their bottom line is. They adopt it as a formal policy. They can share that with a fund sponsor, let them know, what kind of accommodations they need, what the deal killers really are right up front. And that can be a double-edged sword, because if you have a policy that's inflexible like that, you can sort of shut the door on yourself with respect to certain kind of deals. That's kind of the danger. But I've had some clients actually find pretty significant success with that, and not so much find that their downside is as heavy as we have at times feared it might be. We're finding we don't close doors on ourselves. We succeed with getting those terms, the vast majority of the time. And in fact, I've got one particular pension fund client that adopted a standard of care policy a couple of years ago. We're right now just swinging into the project of sort of quantifying the results of that over the first 2 years. And we're early in the project, but we do know from the data we have that it's been pretty successful. The particular issues which tend to be front of mind these days for investor clients in private markets. One is the standard. It'll always be there, and that's fiduciary duty, right? It's always your headline term. And we certainly are finding more and more that exculpation clauses in particular, because that's where you pull back your fiduciary duty. Those are getting aggressive. They've been getting aggressive for a long time. And that's really one of those places where having a policy, formal or informal, but really a formal policy can be very useful. If nothing else, it can get you better terms, but it can also help you define what's good enough, what's not good enough, what's the walk away point. A lot of times if clients don't have a clear idea of what that is, they end up kind of just accepting whatever is the best they can do. And over the course of a whole portfolio, that can really just be a mishmash of terms, which maybe really doesn't reflect your principles to the degree that you would like it to. The other sort of general term is more of a recent development, which is that we're finding in private equity deals in particular, some adjacent deals with similar legal structures, some infrastructure deals, real estate deals. We're seeing a lot of GP-led secondaries, and this is a particular kind of deal that can be really problematic for investors. It's really grown a lot in use over the past 3 or 4 years. And this is a deal where a fund sponsor will send notice to all the investors in the fund saying, hey, we're proposing to pick up particular assets out of this fund, move it into a fund that's being run by an affiliate. So it's a cross trade, it's an affiliate transaction, and that the investor basically has a choice. They can go ahead and roll their capital commitment over into that new fund, or they can sell their investment. So basically, that's where the term secondaries comes. It's a secondary sale if they choose it. Problem is they tend to have a very short period of time to make this choice. The prices can at times be unappealing. The terms of the new fund can change significantly from what the original term was. And overall, it really isn't what the investor was looking for when they first entered this fund. Because you go into, say, a standard PE fund, you're expecting a 3, 4, 5 year investment period, maybe a 10 to 12-year term overall. So you're contemplating a certain hold period, and this kind of throws that all out the window. So it puts investors into a sort of a tough position there, and we're finding lots of investors struggling with ways to deal with those deals, but overall, a real problem for a lot of institutional investors.
Well, I have to tell you, I'm learning from you here. I have not, fortunately, run into this, or unfortunately.
Well, it's new. Yeah, it's newer on the new side. Yeah.
Got it. So I also understand that there's some rulemaking currently underway at the SEC that would address, kind of the points that you've discussed previously. Do you think that this has kind of real potential to change the dynamic in negotiations for these private market investments?
I think it has some potential. Yeah, it's probably not everything the investor community would like to see in their ideal world, but you probably can't hope for the fairy tale. I think there's potential positive movement here. There's a few different things going on here. One, I think a lot of analysts are looking at the preferential treatment aspect of this rulemaking and seeing it as really changing the landscape. And I'm not really sure that's true. There are going to be some limits on side letters, and in particular, there's going to be a requirement that side letters be broadly disclosed across the investor base. The reason I don't think that's going to be a major change is that happens in most funds anyway. We have what we call an MFN process where it's private contractual rights, but for the most part they do exist, and so you get a chance to look at other people's terms within certain limits anyway. What's maybe a little more significant is the rulemaking as it addresses the two issues I mentioned a moment ago. One is with respect to it's really, I'll call it standard of care. It affects indemnity clauses, it affects exculpation clauses. And really what the SEC is doing there is they're looking at exculpation clauses, which is, where the fund sponsor is saying, you can't sue us for more than X, Y, and Z. Well, if you start from a presumption that you have a certain standard of care, you have to, meet a certain level of prudence with respect to your fiduciary duty, that really only has value if it's enforceable, right? If an investor can do something if you violate that duty. So when you take an exculpation clause and say, well, yes, we have a fiduciary duty, but you can only sue us for, say, bad faith or gross negligence or a few different things. That really carves that back. And what the SEC rulemaking is saying is they're basically looking at the exculpation clauses and saying, look, there's certain things you can't carve out. There's certain things you can't limit suits for. And the rulemaking basically reads like a private market LPA that I look at every day, but one that has sort of all the things in those carve-outs that we would like to see. That'll be, I think, helpful if it goes through in roughly the form it's in. I don't think it's going to be a complete game changer, but it's going to shift things a little more toward investors. The other piece of the rulemaking that relates to something I said a moment ago is the aspect that addresses GP-led secondaries. And there I have a little less hope. I mentioned that one of the aspects of those deals is that the investor has a chance to cash out their interest. And what the rulemaking is going to say is if you want to make that offer, the price that you offer has to be subject to a third-party fairness opinion.
Okay.
I will relate this to something that happened last week. I was at an investor conference, major investor, a lot of lawyers in the room, a lot of investment professionals in the room, about 50, 75 people in the room all told. And one of the in-house lawyers for the client posed a question to the group. He said, "Hey, just kind of a sense of the room. How much do you guys rely on fairness opinions? How much stock do you put in them?" Nobody gave a verbal answer. The entire room burst out in laughter. So I don't think that's going to help us that much. I wish the SEC would touch some of the terms and conditions, some other aspects of those deals. It's not a negative by any sense. I just don't think it's a major positive.
Well, you know what? We may have to have you back again as this kind of fleshes out with the rulemaking. So, but Michael, I want to thank you for your time and your expertise today. Certainly, I took away some new knowledge that I didn't have previously, and I want to thank all of you that tuned into our presentation. For more information, please visit us at foley.com under Family Offices. And thank you again, Michael.
Thank you, Brian.